$5.3 billion in debt, loaded onto a single toy retailer in 2005. $0 of it went to open a new store. $0 of it went to build an e-commerce platform. Sit with that before you reach for Amazon as the explanation, because the people who structured this deal already knew how it would end, and they got paid regardless. Here's the story you've heard, the one that gets repeated in every retrospective think piece and nostalgic listicle. Toys R Us was a beloved American institution, undone by the rise of Amazon and the shift to online shopping. Another casualty of changing consumer habits. A sad but inevitable death in the churn of retail Darwinism. It's a tidy narrative. It requires no accountability, no forensic accounting, no understanding of capital structures. It lets everyone nod solemnly about disruption and move on. It is also, functionally, a lie of omission. Not false, just conveniently incomplete. The kind of explanation that survives because it's easier to blame a website than to read a leveraged buyout prospectus. Here's the inversion nobody wants to sit with. Toys R Us was killed in 2005. Amazon was barely a threat to physical retail at that point. The company was still primarily known for books. Toys R Us, meanwhile, was profitable. It had positive cash flow. It had a real, functioning business. Then Kohlberg Kravis Roberts, Bain Capital, and Vornado Realty Trust acquired it in a $6.6 billion leveraged buyout, and the moment that deal closed, the company stopped being a toy retailer in any meaningful operating sense. It became a fee-generating vehicle wearing a toy retailer's name. The insolvency wasn't a 12-year slide caused by external market pressure. It was a design specification embedded in the capital structure on day one, waiting patiently for 12 years to fully metastasize. So let's open the architecture, because this is the part nobody bothers to explain, and it's the only part that matters. Of that $6.6 billion purchase price, only around $1.3 billion came from the equity contributed by KKR, Bain, and Vornado. The remaining $5.3 billion was debt, and critically, that debt wasn't placed on the buyers. It was placed on Toys R Us itself. This is the core mechanic of the leveraged buyout, and it's worth saying plainly, the acquiring firms use the target company's own future cash flows and assets as collateral to finance its own purchase. The buyers put up a fraction of the capital. The company being bought absorbs the liability. If the deal works, the equity holders enjoy outsized returns on a small initial investment. If the deal doesn't work, the company, not the private equity firms, carries the wreckage. This is balance sheet arbitrage in its purest form. Risk transfer disguised as acquisition. Now layer in the fee structure, because this is where the phrase "paid to fail" earns its precision. Private equity firms don't only profit from eventual exits or dividends. They collect advisory fees for structuring the deal. They collect monitoring fees, sometimes called management fees, for the ongoing privilege of owning the company. Fees paid annually, regardless of whether the company is thriving or hemorrhaging. Over the life of the Toys R Us ownership, KKR and Bain are estimated to have extracted more than $500 million through these advisory and monitoring arrangements. That figure is disconnected from performance. It is not tied to earnings targets, same-store sales, or e-commerce growth. It is tied to control. As long as the firms control the asset, the fees flow, whether the toy aisles are full or empty. Meanwhile, the interest payments on that $5.3 billion in acquisition debt came due every year. Over $400 million annually, extracted directly from operating cash flow that would otherwise have funded store renovations, wage increases, inventory modernization, or, ironically, the exact e-commerce infrastructure investment that might have let the company compete with Amazon when Amazon actually became a threat a few years later. The popular narrative has this backward. Toys R Us didn't lack the vision to compete online. It lacked the capital, because the capital was being routed to service acquisition debt that had nothing to do with operations and everything to do with financial engineering executed a decade earlier. The company wasn't outcompeted. It was out-leveraged by its own ownership. This is the incentive misalignment at the center of the entire architecture. The private equity firm's financial success was never contingent on the company's survival. Fees were collected upfront and annually. Equity could be marked up on paper through refinancing and dividend recapitalizations long before any real operational outcome was determined. The people making decisions about the company's capital structure were insulated from the consequences of those decisions. That is not a bug in the system. That is the system. The consequences arrived in 2017 when Toys R Us filed for bankruptcy, and again in 2018 with full liquidation. Roughly 33,000 employees lost their jobs. Many discovered their severance packages were inadequate or non-existent because in the hierarchy of bankruptcy claims, secured creditors and debt holders, the very structure created by the leveraged buyout, sat above the people who had spent years stocking shelves and running registers. The public backlash was significant enough that KKR and Bain eventually contributed to a hardship fund for displaced workers, a gesture widely reported as goodwill and more accurately understood as reputational risk management. It did not restore what had already been extracted. Meanwhile, the original equity investment, in many respects, had already been substantially recovered through years of fee collection before the bankruptcy filing was ever drafted. The asymmetry is the entire point. The architects of the deal were compensated for the deal's existence, not its outcome. Employees, landlords, floor-level creditors, and vendors absorbed a collapse that occurred inside a structure they never designed and never controlled. Here is the part that should unsettle you more than the toy retailer specifics. This is not an isolated tragedy. It's a blueprint, and it has been run again and again on Sears, on Payless Shoe Source, on Shopko, on a long list of retail names that collapsed under acquisition debt while their private equity owners extracted fees along the way. Once you understand the mechanism, debt loaded onto the target, fees collected independent of performance, equity holders insulated from downside while employees and creditors are not, you stop reading corporate bankruptcy headlines as stories about failed management or shifting consumer behavior. You start reading them as autopsies of capital structures decided years before the failure became visible. The retail apocalypse narrative was never the full picture. In many of these cases, retail didn't die from external competition. It died from internal debt service imposed by owners who had already been paid. So the next time a headline announces a restructuring, ask who financed the acquisition, who's collecting fees on the way down, and who's sitting at the bottom of the capital structure absorbing the loss. The answer is rarely a mystery. It is simply rarely asked. Here's the part nobody puts on a plaque. In modern finance, risk doesn't disappear when a deal collapses. It just gets reassigned, quietly, to whoever wasn't in the room when the terms were written.